It's Monday, January the 13th. From The Economist in London, this is Money Talks, a weekly discussion in the fields of economics, business, and finance. I'm Ryan Avent, the economics correspondent.
And I'm Stanley Pignal, the finance correspondent.
This week we'll be discussing disappointing new jobs figures from the United States, watered down leverage requirements for banks, and Scottish independence.
Ryan, let's start with the US labor market. After several months of pretty healthy jobs data, on Friday there was really a surprisingly low figure to come out. Is it a one-off? What's the sense? Is the tide turning on the US recovery?
Well, we've been thinking that the tide might be turning in a positive direction. Going back to August of 2013 through November, the labor market was adding about 200,000 jobs a month, which was a pretty good pace compared to the rest of the recovery. And there was the thought that things were sort of accelerating going into the new year. So December's job data came as a pretty nasty shock. The economy added only 74,000 jobs, which is well below the average for the recovery. And so I think there's a sense now that maybe once again the optimism that next year will be the year it was overstated, and that we're going to have another sort of disappointing string of months for employment. I think that's a little overstated. There's always a lot of noise in the data.
Sure, and the weather was absolutely atrocious.
The weather was really bad in December, and so there's a high potential that once we get some revisions in, this number won't look nearly as bad. Janet Yellen will be taking over as chairman of the Fed later this month, and at the meeting in December, the Fed surprisingly went ahead and pulled the trigger on reductions of asset purchases. And that may look a little premature to people now with this jobs report in hand. It may seem like actually maybe they should have kept going with the pace of purchases they had already until they were really sure that the U.S. economy was really picking up the pace.
The Federal Reserve has said that it would be looking at employment figures before ending ultra-loose monetary policy, right?
They have, and that's interesting because there are two measures of the health of the labor market in the U.S. One is the number of jobs created each month. The other is the unemployment rate. And so the Federal Reserve had adopted this guidance that said that they would start thinking about raising rates around the time unemployment hit 6.5%. And although the jobs created figure was pretty bad, the unemployment rate number dropped a lot. It dropped from 7% to 6.7% in December, which is pretty close to the 6.5% threshold. When you have this much disparity in the figures, where one figure is showing pretty poor performance and the other is showing a big drop in the unemployment rate, maybe the unemployment rate shouldn't be the metric that you're looking at all. Maybe you should look at something else like the ratio of employees in the economy to the total population or something else. So it'll be interesting to see how the Fed reacts to this data and what direction they start to pull in. Let's turn now to the world of banking regulation, where we're only a few years gone since the crisis, and already it seems the Basel Committee is looking at watering down some rules that were put in place to try to limit bank leverage. That sounds like a bad idea.
Sure. So the Basel Committee is the group of global banking supervisors that essentially decide the prudential rules for the banking industry. And what they did on Friday is to dilute one of the measures that had been considered key to making sure that banks don't have too much debt. To many people, watering down rules so soon after the crisis sounds like a pretty bad idea. And it's not the first time that bank lobbyists have had success in paring back some of the regulation that was adopted in 2009 and 2010. The leverage ratio, which they've successfully managed to scale back, is a very crude measure of how much debt a bank has on its balance sheet. It's a measure of how much capital they have against the assets of a bank being the loans that they put out. Now, typically, the way that a bank's capital strength will be assessed will be through a risk-weighted capital measures, which basically takes into consideration whether a bank is lending to the US government for 3 months, which is a very safe loan to make, or whether they're lending to a startup which has a 90% chance of defaulting. The risk-weighted capital measures take this into account, and the leverage ratio, which is very much a secondary measure that regulators have been looking at in the past few years, doesn't. And that's the measure that's been pared back through the Basel Committee.
That makes sense to me, but what's the advantage of having a leverage ratio as the relevant measure here rather than risk-weighted assets?
So the advantage of the leverage ratio is it's simple. You can look at a bank's balance sheet and you can figure out what its leverage ratio is in a way that you can't with a risk-weighted capital, because you need to know exactly what the bank owns, and the bank needs to tell you that, and disclosure has been difficult, it hasn't been uniform, and regulators have been frustrated that they don't really understand what goes on in banks. So the advantage is that it's simple and that it's harder to fiddle. The disadvantage is that it's so crude. Now, nobody's suggesting that there should just be a leverage ratio, but they're calling the leverage ratio a backstop to the risk-weighted, the conventional banking measures. I think there's a strong argument to be made that having a backstop might actually weaken the principal method that we use to regulate banks. It says, like, we're not entirely sure that we trust the figures that the banks are giving to us, so let's make sure that we have this sort of airbag, some people are calling them, this emergency thing, just to make sure that we keep an eye on them. I think that it might actually detract from the core job that regulators have, which is to understand what is on a bank's balance sheet, what are the assets, how safe those assets are.
Well, it's a bit like, do drivers drive more dangerously when they're wearing their seatbelts?
Right, exactly. And it's very easy for a bank to pass a leverage ratio. All you need to do is you need to hold very risky assets. The more risky assets you hold, paradoxically, the higher your leverage ratio is going to be. So that's why having risk-weighted capital that essentially slashes your allowances if you have risky assets, if you make risky loans, is objectively the better way of regulating banks. The thing that seems surprising is that regulators seem to be admitting that that principal method of regulating banks might actually be flawed.
Yeah. Well, and it sounds like at this point we're still really debating what the main cause of the crisis was, whether it was more about excessive borrowing or about banks making poor decisions about what sort of assets they were buying.
Yeah, and indeed different banks toppled for different reasons. Clearly, this is seen as very good news for banks. Their share prices have risen. Some European banks have risen quite sharply. And the hope is with regulators that if you dilute the measures, then the banks won't have to hold as much capital against the assets they have. Or what they could do is they could issue more loans with the capital that they already have. So the idea is that they would lend more to small businesses and issue more mortgages. At least that's a hope. It might be that they just buy more complicated derivatives that go on to blow up the financial system. Back to Britain. The Treasury today said it would assume all responsibility for any debt held by an independent Scotland should it secede from the Union following a referendum later this year. Why would it do that, and what does it mean?
So as you mentioned, Scotland will go to the polls this fall and vote for independence or not from the UK. And the concern is that after independence, the stock of UK debt would be divided up between Scotland and sort of the rest of the UK. Markets might worry that Scotland isn't as fiscally responsible or as fiscally trustworthy as the rest of the UK and not want to hold that Scottish portion of the debt. What the UK Treasury is worried about now is that markets will be worried about that preemptively before the referendum if it looks like it's going to go toward independence and go ahead and start selling that debt. And that would raise UK borrowing costs now, which the government can scarcely afford because they're running big deficits. So what the UK Treasury has essentially said is that markets don't need to worry, that there won't be a Scottish default, that the Treasury will stand behind that debt no matter what. Of course, that raises some very interesting questions. One of which is whether this might influence voters' minds in Scotland, whether the Scots might have been worried that, if we're going to be on the hook for this debt, that's a reason not to vote for independence. And so now this Treasury decision might make a yes vote on independence more likely. Another worry would be that if the UK Treasury has already said that it's going to guarantee or honor these Scottish debts no matter what, why would Scotland go through the trouble of paying them in the first place? And the argument that the UK government makes is that were Scotland to essentially default on these debts, even though the debts would be honored by the UK Treasury, that would make Scotland a pariah in international markets, that they couldn't go out then and get loans from markets because of the damage they would do to their reputation in not honoring that debt.
And surely the British government will only guarantee Scottish debt for a given amount of time, and at some point the Scottish government would have to borrow against its own credit record.
Right. The Treasury is not going to guarantee new Scottish debt that's issued after independence. It's only going to guarantee the debt that's already been issued and that is then transferred to an independent Scotland.
Of course, it all depends how you split up the debt. If Scotland gets relatively less of Britain's debt, then it will be a better credit than if it gets a lot of the debt. And also it depends the assets that they get and the assets that Britain keeps. How are these things calculated?
In very tricky and political ways. But yeah, you're absolutely right. The debt is one issue. The share of assets, especially North Sea oil, is going to be another issue. And then the currency is another issue. Scotland has signaled that if it were to be independent, it would like to continue to use the pound, which would be interesting. It would give up its say in the Bank of England's monetary policy making committee over how strong the pound should be. But it would also benefit from some of the stability that would be associated with using sterling, which is a currency that everyone in markets understands and sort of trusts. So there's some very tricky and political issues coming to the fore here.
But essentially the Treasury trying to stymie any potential rise in British borrowing rates now to calm the markets.
Absolutely right. Thank you, Stanley. If you have any questions or comments, please visit our Schumpeter blog at economist.com/blogs/Schumpeter. In London, this is The Economist.
The Economist.